your sense, was a perfect alignment of interest between LP, GPs, and the management teams of the company. So this like great governance model, right? A superior governance model. Isn't that a bit romantic? I mean, isn't it? That's the theory, right? It seems very pure and very romantic.
But it's reality, at least if one refers to financial alignment as the key motivator for most people to do the things they do every day. So yes, I think it is, in the sense that you have all through the hierarchy, you have an alignment between your LPs and your GPs, and between the GPs and the managers of your portfolio companies. Because contrary to, say, large PLCs, where you have a whole series of incentive schemes that try to mimic this alignment, there is, most of the time, people don't have to put up their own money. And that, to me, makes the biggest difference. We, at Change Capital, at least, will ask every manager that we have in a portfolio company to come up with their own money and co-invest alongside us. And obviously their motivation, therefore, is completely aligned with us. Same thing goes for the GPs. We not only have our carry, which obviously aligns us with investors, but we are one of the highest co-investors in our own fund. We have more than 10% held by the partners in the fund. And whatever most PLCs do, they can get close to that alignment, but they never get totally there, because there is no downside. You have restricted shares or stock options, which are a great motivation to align, but there is no downside. And that downside psychologically has a big impact on what you do every day.
But you could argue this could be replicated, within a PLC.
I haven't seen it too often, but I have one case which I can talk about, and that's Vodafone, where we mimic the kind of skin in the game, as we call it at Vodafone. And maybe just anecdotally, the origin of it actually didn't even. I'm also chairman of the remuneration committee of Vodafone, which adds another hat. So I have the responsibility for making sure there is alignment. But it's actually management who came up one day, Vittorio Colau, when he took his job, and he was familiar with private equity, said, is there a way in which Vodafone would work better if it was owned by private equity? As a theoretical question, of course, because we didn't think we were going to sell to private equity.
No scoop.
No scoop there. And we thought about many things, but the only area where we could find that alignment was in remuneration. So we came up with what we call skin in the game concept, which obliges managers to invest their own money if they want to maximize the long-term incentive. And that goes up to 100% of their net salary every year. And believe me, most of them have invested their full bonus year after year after year, in which gives them then a multiplier depending upon the results and depending upon performance criteria, which leads to quite important payouts at the end of the day, particularly after the fantastic Verizon transaction of last year. So it is doable, but I haven't been followed by many other companies.
Yeah,
so
why do you think that that's not really been replicated? And do you really think that it made a difference? Is it making a difference?
I mean, it made a difference. If I can judge by the ownership that the top management team has at Vodafone, is I think about £40 million. The top 10 people have £40 million invested in Vodafone, which is quite substantial. It's still small in proportion to the total capitalization of the company, but it is a big amount for them. And it goes, like in the case of Vittorio, I think he's got 8 times his annual salary invested in the company, so quite substantial. So I think it does work. I mean, I can judge their behavior every day. Now, would it be very different if they didn't have it? I guess one will never know. But at least they have acted in the shareholder interest throughout these years.
Right.
So I think it helped.
And so you said that it was the only thing where you can find consensus in terms of the private, how to apply the private equity model to Vodafone. What was the other? Can you give us another example where you couldn't really apply?
One other which I'm fond of, and that's the limited time frame of a private equity investor versus a corporation. Because one of the pitfalls that I've seen in many corporations is that large PLCs and the CEOs of those large PLCs make so-called strategic investments for which they're never going to be held responsible. Whenever I hear a CEO say that he made this acquisition, billion-dollar acquisition for strategic reasons, I tend to sell my shares, because he isn't going to be responsible for it. His successor is going to have to deal with it. That never happens with private equity, at least not if they stick to the golden rule of exiting the companies they buy. So that was one of my suggestions. Is there any way in which we could replicate the limited time frame of an investment? And obviously that's very difficult. So that's the one where I feel strongly about that it is an advantage of private equity. It's often seen as a disadvantage because you can't make so-called very long strategic decisions. The reality is, in 5 years you can make strategic decisions, but you are going to pay the price for your results or not.
So you don't believe in long-term strategic plans. You believe in the discipline of 3 to 5 year investment decision.
Obviously, the long-term strategic plans have their value, but it is, again, too often it is an excuse to say, I'm not going to be held responsible for it. So no, when I hear long-term strategic plans as the only reason why someone does an investment, I'm quite skeptical.
So, do you think M&S would do better? Would do better if it was private equity owned?
I can't say today because I'm no longer familiar with the business. But as M&S has a fundamental problem, I think still today, which it had certainly when I left it, which is that it needs to kind of get interested to a next generation, and that needs some very profound changes in the customer profile and therefore in managing the brand and the retail concept. And those are the kind of things which are very difficult to do when you're in the public eye. At least it was the case when I was chairman of Marks & Spencer. We had some very dramatic changes which we announced to the market. Everybody applauded it, but then the next quarter when you came up with your results, they had forgotten about the strategic plans and you needed to show immediate results, which obviously are contradictory to long-term strategic plans. So I never have hidden the fact that I thought that going private for Marks & Spencer would probably have been a good idea. Whether it is today, I'll leave that up to today's board.
So let me challenge some of the the advantages that you think private equity enjoys over listed companies. You said that we have a perfect alignment of interest, but there are cases when you have lots of conflicts of interest. I've written mostly about those cases where you have a GP charging fees to their portfolio companies a lot at the expense of their investors, less and less so. But then if the investor gets back all the fees that have been charged to the portfolio companies, then you could ask yourself whether this is good for the companies themselves and whether there are other conflicts of interest there. There are other cases of potential conflicts of interest, which I write about a lot, is, for example, dividend recapitalizations. I don't really see a perfect, alignment of interest between the company, the interest of the company, and the interest of their shareholders. What do you think about those practices, which probably isn't, the case for mid-market, which is probably not a common feature of the mid-market segment, but it's nevertheless very, it's out there. Yeah. It's this widespread,
I hope there are no representatives of the big KKRs, Blackstones, and whatever here, because I think it is clearly something that I cannot witness as a mid-cap buyout firm, because we have only one thing in mind, that is the health of the portfolio companies that we have, and we want to make sure that they've got all the means possible to develop the company to a maximum, because again, we are being judged on our exit. That's when everything comes together. So if you have kind of exploited the company too much, had put too much debt on it, or had asked too many management fees, it will show in the results of the company, and so eventually you pay for it. Now that is for a mid-cap private equity fund, right. And I don't think any one of us will escape from that reality. The bigger funds have become kind of, have a bit lost the spirit of private equity, I think. And, the sheer fact that they're listed on the stock exchange is already in itself, I think, a bit of a contradiction with the notion of private equity. And I would say that the only safeguard that I can see is to have the absolutely iron discipline to exit companies. Because it will show. If you mismanage the company, whether it be for too much debt or too many management fees, at exit, it will show. But if you hang on to the company, of course, forever, which private equity shouldn't do, at least not in my opinion, then obviously it isn't going to be visible. And the fee culture, as you probably refer to it,
right,
is probably a bit of an issue with some of our colleagues, but only the very big ones, very far away.
Big ones, but like a big part of the market and a big driver of how the practices are evolving in the market.
Yeah. And it gives a bad image, I think, to all of us. It's a bit like what the French politicians are saying. A couple of exceptions create a very bad image of politicians in general. Hopefully, we're not going to go that way. And I think our limited partners should make sure that there is iron discipline. When we meet once a year with all of our limited partners, we get questioned on those kind of things. I mean, we certainly get questions about too much debt on our companies, which we don't, but we would. Management fees are very closely scrutinized, that we stay within reasonable amounts that don't make us rich, but just allow us to manage the companies well. Whereas I think private equity is a superior ownership model, it isn't a guarantee for bad behavior. I mean, you can mismanage with private equity as well.
But it's interesting that investors have been, voting with their feet, by committing a large amount of money to the top, the largest fund, which have deviated from this model, right? Which have invented the model, but which have definitely deviated from it, and as you say, probably, maybe lost their soul or changed the model somehow.
True, but at the end of the day, I think, as you rightly say, investors vote with their wallet, and the fact that they continue to pour money into private equity, more so even today than before, probably is also due because the returns continue to be better than in any other class of assets. So, despite some of the kind of weaknesses, I think it continues to be a very healthy industry. Is
it true? You really believe that it's deliver higher returns?
I think it is.
Does everybody think the same?
If you're here today, you should.
I don't know. I'm asking because there is no consensus if you look at the academic work on whether private equity is actually delivering better returns. So I'm just I'm always surprised when I report on the industry to see that the industry takes it as a given when you actually read the academic research. There's absolutely no consensus. What do you think?
And the previous speaker gave an example of I think it was more venture capital, which indeed, if those numbers are correct, that's not exactly exciting returns. Like in any investment class, I guess you get good and less good private equity funds. So, but in average, it should lead to better results because simply of the nature of the ownership gives us an advantage, I think, over PLCs. Not in all circumstances. If you have a company that relies, like pharmaceutical industry, that relies on sometimes 20 years of investment in order to make something work, clearly that is not, there's no room for private equity there. So I think it depends a bit on the nature of the business which determines the return.
But you told me when we were discussing earlier that you see really the best model is really the family-owned model.
It's something they don't often get in the limelight because they tend to avoid. I think family-owned businesses, I used to work for one, have combined the long-term strategic view, which, say, large PLCs can do, but they're also held responsible because, an owner or founder of a family-owned business has a vested interest that in any investment they make, any decision they make, is going to secure the fortune for their children or their grandchildren. So they have the kind of the discipline of making sure that investments work well and the long-term view. So that to me is a fantastic combination with one caveat, and I've lived through that as well, and that is succession. the entrepreneurial genes are not necessarily transmitted to the next generation. And when I say not necessarily, probably not. So therefore, for any family-owned business, the key thing is to make sure that when you run out of talent in the family, that you get yourself professional management and behave as the shareholder. That transition is not always obvious. And when I see some very big captains of industry appointing their children to key positions in the company, I go like, I wonder why would he think, or he or she, think that their children are necessarily better managers than the rest of the population. So it's always a bit of a worrying sign. But apart from that, I think family-owned businesses do very well.
And we have seen the emergence of very entrepreneurial groups like ALTIs, which kind of replicate the private equity model, but with being listed and also being family owned and entrepreneurial driven. So, and it seems that they've been very successful. Is it a new model emerging, you think?
Could be. It's trying to kind of replicate the private equity discipline within a family environment. But it basically responds to exactly the same logic. Yeah. You, as a shareholder, you own the company, you control the company, and you run it for results without having to worry too much about the outside world. So, I think you called it sous tutelle, I think.
Yeah. Yeah, I mean, you were discussing about how the private equity ownership is in essence very tight control over management, and in a way, it's a way to not trust the management fully in achieving good returns for their investors. It's a bit.
It's not that you don't trust them, but again, through the alignment and through the fact that you call the shots, you know that they will behave well. It was, I think there is more and more shareholder involvement in public companies today, and that's probably most of the time a good thing. And that goes, I was telling Anne-Sylvaine earlier that had you told me 20 years ago that I would have had to go to my shareholders to approve the remuneration policy, I would not have believed you. But that's a reality today. So just imagine what would happen if your shareholders voted against your remuneration policy.
Right.
The reality is that you get, even when there's a lot of protests, I think last AGM at Vodafone, we got a 99% favorable vote. And I can simply not imagine that 99% of my investors were in agreement with the remuneration policy. The reality is that they vote, again, with their wallet and don't really get involved in corporate governance. And so, whereas in theory, today's public companies would have the same shareholder interest to get involved and to call the shots, they don't, because they are basically speculators as opposed to investors. They sell and buy shares, and hopefully they do exactly the opposite to what the rest of the world does, so that they make money.
What about some of the new funds that have been raised? Like I'm thinking about Cevian, for example, which kind of raised a sort of a kind of private equity fund, but targeting publicly listed company and trying to apply the same recipe. You believe in this?
If they can take control of the listed companies, then
without
yes.
Taking control,
but without control, I think it's a complete But that takes away exactly the strength of a private equity firm, is that you call the shots. If you, as a private equity firm, you have two handicaps. First of all, you do not call the shots. Secondly, you need to exit. Or at least in theory, you need to exit. How do you decide to exit a public company? Selling it, which if you don't have control, you don't. So I think that there are many combinations which I think work well, like families that control public companies, I think do work well. But private equity firms that invest in public companies and de facto control them because they have 10 or 15% of the shares, to me that is not very healthy, because it creates an inherent conflict of interest between one shareholder who needs to get out and the others who want to stay in. So I don't think it's very healthy.
You had the example of Carrefour and Colony and
which is
and LVM and Goparno.
Yeah, which combine that with the high leverage, which is also one of your topics. Clearly, the private equity owner wants to reimburse its debt as fast as possible, whereas the rest of the shareholders, 85% by the way, would like the company to invest in expansion. So if you see that company since that ownership has gone nowhere and has sold some of the crown jewels. In my opinion, that's a good illustration that that's not a good combination.
Do we have any questions? I mean, it would be great to have any questions from the floor. Yes? Yeah, we'll have one here. Oh, here. Oh, here. Two questions here.
Hans van Zwaai, you are clearly very much in favor of exits and relatively fast exits. What do you say about the general statistic of private equity at the moment, about $3.5 trillion invested in private equity, $2.5 trillion in companies' inventory, if you like. And that's grown and grown and grown and grown. That combined with a remark made yesterday on what people call restructuring of LPs, limited partnerships, i.e. you re-give the management an incentive, usually at sort of lower level, so it's easier to achieve, so they can carry on a little longer on the stuff that they apparently haven't achieved before.
That's a question for Anne-Sylvaine, no? No, I'm a great believer in exit because it instills a discipline which I think it's hard to replicate in any other business. So you recruit a management team, or if you have a management team, you set yourself a clear goal. Most companies, by the way, develop themselves staircase-wise, so it's not like as if it's a linear development. You set some clear goals, and you help management to get there. And in our case, we'd rather look at 5 years as an investment horizon. If you can't make it in 5 years, that means the nature of the business probably isn't good for private equity, or something went awfully wrong. To reset the clock, I guess that's like resetting the clock for a bonus. I mean, if you have a management team that's completely demotivated because they know they're not going to get there, you may just as well adapt to reality and set new goals. Because otherwise they're going to leave, and you find yourself without a management team, which is definitely not the way to go. So there's nothing wrong with resetting, as long as, but you have to, if you do it too often, I guess you have to justify to your limited partners, because they're going to be very happy by resetting the clock. But with management, I think sometimes it is indeed justified.
There was one other question there.
It's very interesting what you're sharing about the hybrid business models between public and private ownership, and just pushing your point about family-owned businesses being a very strong ownership structure. Be interested in your thoughts on what we're seeing with some of the largest LPs in Canada, for example, who are actually now going direct, and whether that's a trend you are likely to see more of large LPs being long-term direct owners of businesses.
I think that there are probably a large number of LPs who have dual investment theories, whereby they would invest in funds and at the same time be investors, direct investors in companies, or co-investors alongside the private equity fund. I would hope that they don't all go direct, because that would eliminate the private equity funds as an intermediate. And believe me, whereas I'm now in private equity for 11 years. It is a business that is to be taken seriously. It's not. You don't learn it like you don't learn it in school, and you don't learn it on the spot. It's a tough business to be in. It's a discipline, and it uses techniques that are not necessarily given to everybody. So if you, as a limited partner, want to go in direct investments, it's no different than if you are a venture capitalist or whatever. But I would caution, because it's if you want to get the same results with the same kind of structures, it does take a lot of expertise. And personally, I think I'd been a good investor in my old days. But I must say I learned a lot from my two colleagues that came from private equity, from Bain and Hicks Muse, and they're using techniques that I think are not today not even known by big corporations. So it's pretty powerful.
You mean financial techniques? Or?
It's analytical techniques. It's the way, again, a very disciplined way in going about evaluating investments in a very rigorous and routine way. Going from the one pager to the 10 pager to the due diligence. Due diligence is very well orchestrated. So I think it's a profession that is by now very well equipped, and I wouldn't recommend everybody to try to mimic it.
Any other question? Yes. Last question.
The champagne is coming, so we better hurry up.
Okay, we focused with your speech on the structures, but when making investments, the character and the leadership of the team is obviously great. And since you've held top leadership position, I'd like to have your 2 cents or 2 sentences on leadership. What's leadership, and how do you evaluate the CEO and investment you're making as a piece of the value?
Very good question. We pride ourselves at Change Capital to be very operationally minded, and that's not by surprise, because 2 of the 4 partners come from the industry and basically are trying to make investments only in which we can bring added value. And so the screening of our deals is based upon solely on that. If we don't find added value in operational expertise, we don't do a deal. Because otherwise we'd just be competing for financial returns, and that's not, we don't always win on pure financial criteria. So for us, obviously the leadership of the companies we buy is essential. We obviously bring our expertise to the party, and to me the kind of people we recruit as top managers reflect the kind of managers that I like to work with at Carrefour, Vodafone, or Marks & Spencer. It's leaders who understand the knowledge of delegation. As I used to say it, I mean, for me, the chief executive officer role should be redescribed as chief enabling officer. So people who enable their organization to be at their best, which I think is the best description of a great leader.
Do you change management at Change Capital?
At Change Capital, not too often, but we have a very stable team. But in our portfolio companies, yes, absolutely.
Is it something that you do?
It's not necessarily. Sometimes we are lucky to find a fantastic management team to start. I think this Jill Sander acquisition was a good example of that, where we had Gian Giacomo and Raf Simons as the 2 leaders of the company, and they've done, one of them is head of Versace and the other one is creative director of Dior now. So
nice.
It was a great team to have, and we didn't need to do much other than complement them with the kind of skills that they didn't have, which was more in retailing and international expansion. So in that case we didn't have to change, but in many other cases we have to change management, and we will do so without hesitation, which is another characteristic of private equity, I think, versus public companies.
I think our time is up. Thank you very much, Luc, for your time.
Thank you for coming all the way from London to interview me.
Yeah, no problem.
Great.
Nice.
Thank you very much.